How's it going, everybody? Welcome back to the channel. Welcome to the channel. What is up? Anyways, so I just read this fairly interesting article. It's not too bad. It's a little interesting. It talks about something called the worry gauge, all right? So basically what this article goes on to talk about is when people are really fearful in a way, it's actually a good thing, all right? So it's been read a few times before. I'll get into the article in a bit, just going to talk about it for a minute or so, and then I'll read you this article and we'll go over all the deets. All right. So basically this article is saying that there's a worry gauge. The worry gauge comes into effect when a few factors are in place, like the price of gold and small caps, and that determines this gauge. All right. So we're going to go into that right about now. But the first thing you got to do is you got to remember to smash that like button, hit the subscribe button, and turn on that bell notification to stay notified on all the latest, greatest, and most amazing videos that I post, hopefully. Anyways, let's get into this article and then we'll talk about it. This article comes courtesy of the people in blue from CNBC, and it's called "The Worry Gauge Shows Investors Are Still Really Scared and That Could Drive Stocks a Lot Higher." A behavioral-based worry gauge has been at the highest quintile for the past few years. Unlike any in at least the last 50 years, the contemporary bull market has coexisted with a tall and persistent wall of worry. Strategist Jim Paulson says, "The worry gauge suggests more investors already expect and are prepared for a difficult future. Looking at stocks' forward performance since 1970, when the worry gauge was at the top quintile, the S&P 500 pulled off an 18.48 annualized return within 3 months, or 4.33% non-annualized," Paulson says. That's pretty crazy numbers. With the S&P 500 sitting less than 1% from its all-time high and on track for its fourth straight monthly gain, cautious investors can't help but worry how long they can still ride on the back of this aging bull before everything comes crashing down. Investors are used to erring on the side of caution. In fact, fear has been accompanying this record-long bull market since the beginning in 2009, and the persistent worry is bound to drive the market to new highs, according to James Paulson, Leathold Group chief investment strategist. Unlike any in at least the last 50 years, the contemporary bull market has coexisted with a tall and persistent wall of worry, Paulson said in a note to clients. The worry gauge suggests most investors already expect and are prepared for a difficult future. Paulson looked at the ratio between the price of gold relative to the overall commodity price index, which he divides by the price performance of small caps stocks relative to large caps, which he calls a behavioral-based worry gauge. Investors tend to flee to safe haven gold when risk is off and turn to more aggressive investments like small cap when they are confident. Chart 1 worry gauge. Ratio of the relative price of gold price / GS commodity price index, so the gold price, divided by the relative price of small cap stocks, Russell 2000 / S&P 500, dashed red lines represent quintile breakpoints between January 1970 and April 2019. So there's a little graph here at the bottom that says prior to December 29, 1978, Kenneth French's small versus large stock market relative SMR was used. Relative price of Russell 2000 and S&P 500 data thereafter. So if we see here, he has a couple points. It's obviously very low in the 1970s. It looks like, it's hard to say when that is, but it's definitely before September 2018-ish. Maybe the beginning of 2017 somewhere. It was really high at its peak at 8. And you could see it's pointing to August 1987. That would have been close to when they had the recession in the 80s called Black Monday, but that ended up happening in October. You see they have February 1999 here. And March 2000, those are obviously the dot-com bubble. Then you have July 2007 to June 2008. That was obviously when the financial crisis was happening and the housing bubble burst. So that was not a good time at all. Then you have February 2009, which is when stocks started to rebound. And then you have pretty much throughout most of the bull run, it was sitting in between that 2.5 to about 4.5 line. And then it goes really high, and then you can see September 2018 actually dipped back under 4.5. And in December 2018, it was above a 6, and now it's somewhere over there. So let's continue reading on. It turned out the gauge has been in its top 2 quintiles almost 75% of the time during this bull market. The reason for the degree of fear is that investors have witnessed many worrisome economic signs in this expansion, including sluggish growth rate and job gains, as well as the record low global interest rates, Paulson pointed out. The worry gauge soared amid the global manufacturing recession in 2015 and continued to stay on the high level from then on. The only time in the last 4 years the indicator has dipped below its highest quintile was when the stock market peaked in September 2018. So you can see by this graph, it says the S&P 500 in 1 year. So it shows its peak in September of 2018, its eventual downfall, and how December 24th was the worst day, and then it's picked back up all throughout 2019. Now, if you look back at this chart, it shows that in September 2018 was when it actually hit that red indicator point. So that was actually the high, which is kind of interesting because it basically pinpointed that high perfectly. And then you could see that after that, it then went back up. All right, and December 2018 is the low, and that's actually the peak there. So pretty interesting when you think about this, right? So what does it mean for the market? Looking at stocks' forward performance since 1970, when the worry gauge was in the top quintile, the S&P 500 pulled off an 18.48 annualized return within 3 months, or 4.33% non-annualized, Paulson said. What's more, there has only been a 25% chance that of a loss within 13 weeks. As it has during much of this recovery, the stock market continues to climb a wall of worry, Paulson said. To be sure, many factors are at play when projecting the market's direction. While the fear-based investment actions point to more gains on the horizon, risks such as an accelerating earnings slowdown and Federal Reserve policy uncertainty could still weigh on the market. So, fairly interesting article. Obviously, there is some fear in the market right now, but by that article, there's not too much to worry about. At the end of the day, you can look at all these indicators, and yes, they're interesting, they help, there's all this stuff. But at the end of the day, you have to judge how companies are doing. Now, the one thing I hate is that a lot of people will say, we're in the longest bull market. That's true, we are. We are in the longest bull market ever. And then people will then say, so it has to end, right? Now, I don't like that at all, because I don't believe just because you passed the longest bull market, there's now a doomsday clock on it, say like a countdown. Like, it can't last for another year. It can't last for another 2 years or something like that. There will be a recession eventually. It's just life, okay? It's like one of those things. You're going to pay taxes. You're going to die. There will be a recession, all right? Now, I don't think the third one goes there, but it's true, okay? Things happen in life, all right? This is something investors have to be prepared for. They're just natural. Honestly, they are. Recessions happen, okay? The economy is not going to do good forever. Things fail and then they pick back up stronger than ever. And no recession has re-happened, all right? As in the financial crisis. Now, obviously that was fairly recent, but that hasn't happened again, obviously. And chances are that it won't happen because you now know what to look out for. Same with the dot-com bubble. That one has a higher chance of happening, but there would have to be a new invention like, say, the internet, which we already have, so we have to have something even more robust and amazing than the internet, which is probably going to be hard to beat for quite some time. All right. Then if we look in the 1929 Great Depression era, well, that was obviously a different time too. You have to remember that at this time, they're coming off of like a world war, all right? They're basically gearing up for a World War II. Like, this is a much different time. We don't even have world wars. We have, obviously, terrorist attacks and other catastrophically terrible events that people do, which are mind-bogglingly terrible, but we don't have any world wars where millions of people go and die, all right? So thankfully that hasn't happened and hopefully never happens, but these are all different times, all right? And they're all happened for different reasons. So just because we're in the longest bull market doesn't mean it has to end today, tomorrow, something like that, all right? It will end when it ends. And the best advice I could give to you is, I've said this before, but when you're picking a company, all right, what you need to look for is no different in a way than what you look for when picking a house, all right? When you pick a house, the very first thing you look at is the house, all right? So when you're picking a stock, the very first thing you look at is the company, all right? What do they do? How's the house? Type thing. Then once you get out of the house, you're looking around. You're like, oh, nice trees. My neighbor's houses look okay. Their cars look okay. There's not one person that looks really bad or something like that. It looks decent. It looks like a nice neighborhood. Looking at schools. Oh, look, there's a school over there. Oh, there's a nice park. There's restaurants. There's this. They got a Starbucks. This area is definitely legit. Like, this is the things you look at. Now, in a company, you're going to look at the company itself, and then what sector does it operate in? Is it in technology? Is it in this? How is it doing? Is technology doing amazing? Are they in the printing business? Okay? If they're in the printing business, that's probably not something you want to be in. Maybe if they're in the 3D printing business, not bad. But if they're just literally printing inkjets, like, stuff like that, maybe you want to get out of that business type thing. Are they innovating? Like, stuff like this. And then the last thing you want to look at, where is the house in the city, okay? And the city itself. So the city is like the stock market, all right? So imagine you go buy a city in San Francisco, which is doing absolutely fantastic right now. And you're like, okay, the city's amazing. How is the stock market doing? That's the last factor you need to be concerned about, all right? If everything seems great, then you're probably good to go. So just remember that. So if a recession happens and you got the first two boxes checked, you got a great house in a great neighborhood, a great stock in a great sector, okay? In a great field. Whatever they do well, all right? And they're the best at what they do type thing, or they're up and coming at what they do, all right? This is something you have to look at, because if those two things are good, obviously the financials and all that's going to come into play, and during recession they'll probably take a hit. But just remember that those two things are more important, all right? And if those two things are doing well, then the third thing will eventually pick back up and it'll be fine, all right? And remember that if you pick the good company that has those two things, all right, it's good solid company and it's in a good sector, and a recession happens, think about it like this. You go to the store. You're at the store, you're shopping around, you're like, oh, what do I need today? What do I need? Well, I still got to use the washroom, so I got to buy some toilet paper. Toilet paper's on sale. I don't want toilet paper because it's on sale. It's 50% off. Who wants toilet paper? I don't need toilet paper, but you do need toilet paper. So you're kind of like, well, I don't want to use my hand or, newspaper, so I should buy toilet paper. But wouldn't it being on sale be an incentive to buy it? You would actually be at the store and you'd go, oh, look, toilet paper's on sale. I should buy more. I should stock up, if anything. Maybe I'll buy 2 instead of just 1, right? Maybe instead of buying just 1 pack of toilet paper, I'll buy 2 or I'll buy 3 or something like that. It's the same with stocks. If it's on sale and it's still a good product, why are you going to go, no, let me sell it now? No. You look at it and you go, you know what, instead of buying maybe like 1 share, 10 shares, let me buy 50 shares. Let me buy 100 shares. Let me buy 1,000 shares. Let me buy more than I should. And don't buy it all at once, I should say. Always do SIP, small initial positions, and do like that. Always average down, all right? That was like my first mistakes I made when investing was I would buy all at once pretty much, and then I'd go, I went lower. Shit, I could have bought more. I could have bought 10% more for cheaper, and then I would have made money as it got up. I would have had more. All right, so always do SIP, always do that. So something to keep in mind, like when products go on sale, you don't run away from them. Warren Buffett says it too. I'm basically stealing this from him, just saying it slightly different. He says it better than I do. But he says this, all right? When products are on sale, why do you just not buy them? You buy them because they're on sale. They're still good products, It's the stock market really is the only thing in the world, I believe, that when things go down and become cheaper, people panic, sell, and they're like, no, I want nothing to do with it. And then when it's skyrocketing up, people are like, I should buy some. The absolute opposite you should do. Like, I don't get it sometimes. Anyways, hope you enjoyed the video. Let me know if you're buying stocks. What stocks are you buying? What is happening with your portfolio? Are you up? Are you down? How's 2019 been for you? Is it good? Is it bad? What stocks do you own? What stocks do you want me to review? I don't know, anything. Anyways, hope you enjoyed the video. Hope to see you next time. And remember to always have an amazing, beautiful, life-changing day. And I'll see you next time.